Markets are a bit stretched here. We did break out last week. We talked about this consolidating rising wedge pattern. We've broken out of that. That's bullish. We came back down and retested that breakout. That's bullish. We're on a buy signal on a short-term basis as well. That's bullish. But markets are starting to push up into fairly overbought territory.
Welcome to Thoughtful Money. I'm Thoughtful Money founder and your host, Adam Taggart, welcoming you back here at the end of the week for another weekly market recap featuring my good and somnolent friend, Lance Roberts. Lance, how you doing?
Good morning. How are you?
I'm pretty somnolent, which is why I picked the word.
Right.
For those that aren't up on their SAT words, it means sleepy or drowsy. And that's because we have the Thoughtful Money Fall online conference, which folks are actually watching this video when it launches. The conference is happening at the same time. So I'm actually there giving a 10-hour parade of some of the best faculty we've ever assembled for one of our conferences. But I didn't want folks to get shortchanged on their weekly market recap. So I appreciate you recording this for me, Lance. Folks, if you wish you had signed up for the conference and just didn't get around to it, don't worry. You can still buy a replay of the full event. Just go to thoughtfulmoney.com/conference. You can buy the replay video there. We'll send it to you as soon as you buy it. If it's after today, the day this launches, if it's still during the day, you got to wait for the conference to end and for us to edit all the videos, but they'll be coming shortly. And also, don't forget, if you're a premium subscriber to our Substack, you'll get an additional $50 off of the replay video price. All right, Lance, look, lots to talk about this week. You came out with a really interesting piece that I do want to get to, kind of about the broken window theory,
Sure.
which has to do with some of the hurricane rebuilding stuff that's going on. I think it's got some applications to today's markets. Real quick though, maybe let's talk about what the markets have done this week, because we're still up at pretty high levels. I'm hearing more and more people begin to question, hey, are things looking toppy here? Obviously, we're super close to the election. Do you still expect any volatility pre-election, and are you still expecting a pop post-election?
Well, yeah, still expecting a pop post-election simply because you have $6 billion a day in stock buybacks that start back on November the 1st. So, this whole market is simply a function of liquidity. And, it really doesn't matter what you think about the market, liquidity is driving it. And we've kind of talked about this recently, which is no matter what you think is going on in the markets, the things that we talk about is like, really retail sales or economic data or this or that, or the Fed cutting rates. Those are all rationalizations at the end of the day for why the market's doing what it's doing. The reality is what drives prices is supply and demand of buyers versus sellers. That's what moves prices. And what fuels buyers versus sellers is liquidity. And we just have a ton of it globally coming into the market. I've got some charts I can share with you this morning, but the amount of buying in the market over the last month has been just absolutely phenomenal.
Hey, let me just make one note of that. Folks, if you didn't see it, there was a video I did earlier this week with Michael Howell of Cross Border Capital. Those that know Michael know that liquidity is kind of his bag, right? Yeah, that's the thing he primarily focuses on. And he was really early in becoming bullish. He became bullish at the end of 2022, saying, hey, global liquidity outflows have bottomed and they've gone net positive again. And then he predicted that prices were going to do well after that. And he remained bullish all the way through 2023, all the way through 2024. Looking back, he nailed it, right?
Mm-hmm.
And if you and I have talked to Lance at times of like, gosh, really, are we just wasting our time talking about all the other elements and features there? And should we just look at liquidity? And I've talked about should that just be at the top of the front page of every business newspaper around?
Yeah.
And punchline with Michael is he said, look, he expects liquidity to keep rising, so he thinks 2024 is going to end fairly strong. Liquidity is going to keep rising. These kind of happen in sort of 2-ish year cycles, maybe 2-3 year cycles, and we still have room to go in this current cycle, but it's the impulse you have to watch out for, which is the rate of increase of liquidity slows down as you get near the peak of the cycle. And looking towards next year, he says, look, there's a whole bunch of debt refinancings that are coming up, right? This is the corporate debt maturity wall that we were talking about a year ago, and then it's kind of fallen out of the headlines. He basically is saying, back to our talk about the lag effect, we're going to start seeing elements of the lag effect as we go into that debt maturity wall, and those refinancings are going to suck liquidity out of the system. So he's basically saying, yeah, liquidity is going to keep rising, but it's going to get less and less fun for investors. It's going to get more volatile. You might get gains in 2025, but they're probably not going to be nearly as good as what you've got in the past 2 years. And he thinks by the end of the year, it's actually going to get pretty rocky. And he says 2026, looks pretty ugly from a liquidity standpoint and what that means for markets. Now, obviously, he'll update us along the way as we get closer to that. But that's kind of his big liquidity arc. And then interviewing Darius Dale for the conference that's going on at the same time of this, Lance, Darius was going sort of through his analysis and pretty much said the same thing. And I always like it when analysts have their own independent approaches, but are coming up with the same conclusions. That makes me just put a little bit more weight on that. So wanted to get all the liquidity part out there.
So yeah, so pretty much that's the whole story. And yes, to your answer, all the other stuff you talk about is irrelevant. It's great it's great for topics and headlines, but at the end of the day, it's all about liquidity. And look, you're right. In fact, this morning, we were having our investment committee meeting at our firm, and we were all kind of sitting around the Zoom because we're all spread out now. But the thing is that clients are amazingly happy right now. It's just, the returns are great this year. They're very happy with their returns. And they're like, this is great. We just got to keep this going. And so, we're starting to lay out this reality for them that says, look, the markets are up 56% in 2 years. That's an abnormally large return for markets in a 2-year period. 25% a year is just amazing, right? And so, yeah, going into next year, you should certainly expect a return that probably normalizes itself. And that's going to seem like it sucks. You talk about, investors are going to have to kind of adjust themselves for next year. If you crank out an 8 or 9 or 10% return next year, it's going to seem terrible after 2 years of 25%. It's like, man, this market's awful. It just doesn't do anything. But that's just normal. Normal returns in markets are 8 to 9 to 10%. These 25% returns are just completely abnormal. And
can I make an analogy? It's kind of like, a football team that wins the Super Bowl twice in a row, right? Where it's like you had 2 fantastic years, right? And the third year, your odds of winning the Super Bowl again are incredibly low. Now, you can still have a winning season,
sure,
right? But it's going to feel disappointing to the fans, right? Wait a minute, how come we don't have our 3rd Super Bowl ring? And it's because it's like nobody, hardly anybody gets a three-peat, right? So, it's sort of like, yes, you still want to try to play for the winning season every year, but don't get too greedy and just too unrealistic that every year is going to be a Super Bowl just because you had a fantastic year the year before.
Right. And there's a couple of components about this, and part of it is psychological, but so this chart I'm showing you right now, this is global liquidity. And this is overlaid against the ISM manufacturing index. And I'll show you an interesting thing about ISM as well. But, the amount of liquidity that's coming to the market suggests that the economy is going to get a lot stronger next year. Just the simple flow through of liquidity into the economy should start to see the manufacturing indexes start to improve next year, come out of recession, contraction territory, go back into expansion. That's going to be supportive of markets into next year. So again, the turn up in liquidity is the one thing that's driving these markets, and that's going to continue well into next year. Now, to your previous point, that liquidity cycle is going to peak next year. And then we're going to start having a reversal of that liquidity cycle. And again, that's going to be lower returns, more volatility in the markets going into 26, 27, and then but predicting anything that far out is just terribly risky. I mean, anything more than a month out is just guessing. But we're just looking at historical trends, and where we are in a historical trend basis, suggests that we should see a fairly strong recovery. But talking about this issue with kind of exuberance in the market, what amazed me is that the amount of liquidity coming in the market, like I said, is just absolutely phenomenal. This is leveraged fund exposure, just in general, and long and short. And the blue line is the net exposure of leverage. The light blue line is the net leverage exposure, long and short. The amount of leverage that investors are taking on right now is just absolutely phenomenal. The last time we had this much leverage in the market was in late 2021. Of course, we had the correction in 2022. This is the. Go
Sorry,
ahead.
can you just go back to the previous chart?
Sure.
I just want to underscore, look how minuscule the readings from 2008 look.
Yeah.
Right. I mean, we had a massive market correction where many people, argued that we had irrational exuberance in the market. But like, if you look at market leverage as a measurement for irrational exuberance, what we had back then is nothing compared to what we have right now.
Well, I mean, look, and you got to keep this in the. This really is kind of the interesting story. Is you talk about 2008 exactly, but in 2018, right here. This was the sell-off, that 20% correction that we had in 2018 when the Fed said, oh, we're nowhere near neutral rates. President Trump started chastising the Federal Reserve for not cutting rates. At that point, of course, the Fed did start cutting rates in 2019. And then we had this market melt up in 2019. So in 2019, the headlines were all ringing out everywhere. It's a massive bull market. It's a melt up. Everybody's talking about a market melt up because the market just accelerated in 2019 because of the Tax Cuts and Jobs Act really started to impact markets. Those tax cuts really impacted markets in late 2018 and starting in 2019. So we had this massive melt up going into 2019. And then in 2020, of course, you had that 35% decline. But that's the pandemic. That big drop right there is the pandemic. That's that 35% decline in the market. But it just basically doesn't even show up compared to the rest of the stuff that's going on in the market. But this is how dwarfed and really out of context things have gotten. And I said, the number of people piling into leveraged ETFs is just absolutely phenomenal. There's so many people piling into single stock ETFs. They're running out of names now to actually launch more single stock ETF names. And then this is just basically the number of contracts really since kind of the beginning of this year have just gone, options have just gone on the call side, have just gone absolutely crazy. So, the amount of leverage that individuals are just throwing into the market is just phenomenal. And it's not just US. We've had a massive flow of foreign dollars into US equities and also bonds. There's also been a very similar flow of foreign purchases of US bonds over the last several months as well. So money, again, is just piling into the U.S. because this is the safe haven. If I'm in any other country right now and I want to store physical reserves, I store them in the U.S. Either I buy stocks or bonds in the U.S.
Well, you're also getting better treated here too. I think even the speculators want to come here. Yeah,
absolutely. No, absolutely. This is a market of markets right now for investors. So if I've got capital to invest, I want to, what's my choice? China or the U.S.? It's a pretty easy choice where I'm going to put capital.
I again interviewed him for the conference that's going on right now in parallel, but I can hear Brent Johnson doing a bit of a victory lap here right now as you're going through that data.
Well, no, I mean, this is the same thing that I've been talking about forever is that, everybody, when, we were writing articles, 3 years ago, when everybody's like, oh, the death of the dollar de-dollarization, we're like, no, it's not what's happening. And that's not going to happen. And, the dollar weakens and strengthens from time to time, but the dollar's had a strong tear over the course of about the last month as all this money's flowing into the market. That's basically money getting put into the US dollar through other assets, but it's basically storing foreign reserves, and that's increasing the dollar strength.
And it's funny, everyone's saying like, nobody wants to own US treasuries, but it's like, they're not giving up on the US though, folks.
And look, they're still buying U.S. treasuries. Trust me, there's plenty of money flowing. The U.S. Treasury just had two of the best stop throughs on the 30-year and the 10-year auction that we've had in recent history. So yeah, there's plenty of demand for treasuries out there.
Great. I actually had that on my list last week, which we didn't get a chance to get to. So I'm glad you mentioned that here. Hey, real quick, let me just ask you. So Lance, make the argument for me why this dramatically increased inflows plus higher leverage is a sustainable new normal?
It's not sustainable, and it's not a new normal. It's just we're in a very bullish phase of the market, and that can last, a couple of years. It will end, right? And we're going to have, at some point, we'll have a 15-20% correction when it ends, because all this leverage has to reverse. But it's just not going to end today, and it's not going to end next month, and it's not going to end, by the end of the year. So, but there's a lot of things that can occur next year that can reverse liquidity flows. The thing that will get the markets is going to ultimately be some exogenous, unexpected event that nobody's planning on.
Yeah, and it's the bullet it doesn't see coming. Yeah,
right. That's what always gets the market. It's always some unexpected event. And the thing that we talked about previously, and this is the most important thing, is that when you come back to talk about, you're worried about the market crashing or whatever, right? It doesn't matter. Liquidity drives the markets. And if you want to know if there's any risk in the market, watch credit spreads. And that's this, right? This chart. This is the chart of high yield. This is basically junk bond credit spreads, junk bonds to corporate bonds. And there is no risk perceived in the markets right now. Now, that will eventually change, and something will happen that will cause a shift in sentiment. And you'll start to see credit spreads start to rise. And when those credit spreads start to rise and break that downtrend, and this will be before the actual spike. This will happen before the event, because the credit market will sniff it out. And the credit market will say, hey, something is occurring, whether it's repo blowing up, whatever it is. The credit markets are going to start to sniff it out. Those spreads are going to start to widen before the event actually occurs. And when the event occurs, we're going to say, oh, well, there's, nobody could have seen that coming. Well, yeah, credit spreads are going to tell you that's coming before it happens.
And let's take a minute and actually help people understand why credit spreads are the canary in the coal mine. So, credit is a contract, right? Unlike stock, which is sort of a story, and you got to kind of, have some faith it's going to do better tomorrow than it does today, whatnot. Credit is literally just smart guys making contracts with each other. I'm going to lend you money for this much for this period of time, and I'm going to assess the risk getting paid back, right?
Right.
And when credit spreads are low, at least the credit spread, there are all different types of credit spreads, but the main type you're talking about is the difference basically between investment grade and high yield credit, which otherwise is called junk, or safe versus risky. Let's call it that way, right?
Correct.
and when the spreads are low or tight, it means that people aren't that worried about risk, because they're willing to loan money for a risk. They're willing to buy riskier debt at a similar premium as they are safe debt, right? In other words, they feel pretty good about getting paid back no matter what the transaction is, right? And that's a sign, as you said, that people just aren't really worried. As worry starts creeping into the system, these guys are doing their calculations. They're like, you know what? I really don't think they're that even now. I'm really beginning to realize that the risk is different, and I got to get paid a little bit more to hold that riskier paper, right? And the reason why this is important is for a market shift, you have to have sentiment change. You have to have a critical mass of buyers and become sellers, or vice versa. And the credit spread is basically like the first domino of the change in perception, right? So if that first domino hasn't fallen yet, even if you're super worried about, have valid worries about real concerns, the tight credit spreads tell you that the fuse is not yet lit. But once that first domino goes, then you need to say, okay, look, whether I know what the risk is or not, I'm suddenly seeing the credit markets becoming more nervous. I got to try to figure out why.
Well, again, you have to remember, you have to understand, in the credit, you're right about everything you just said is absolutely correct. The big difference, though, between the bond market and the stock market is that the stock market investors are just all based on hope for the most part. They're just hoping they're going to buy something at this price and it's going to go higher. In the bond market, it's all about fundamentals. It's balance sheets, it's cash flows, it's income statements, it's economics and how it impacts that. It's inflation risk, it's interest rate risk, it is opportunity risk. There's all these risks that bond investors calculate into bonds, because to your point, and as you said, I'm loaning money to somebody else for a period of time, and I have a fixed rate of return on that. So I loan money to Adam at 5%. In this current environment, A, I want to make sure I get paid back. That's credit risk. B, opportunity risk. Could I do something else with that money at a higher rate or not? Right? Or is Adam my best choice? And C, do I have inflation risk that I have to be concerned about that will, because I'm only going to get that 5%, the money I loaned Adam, he's only going to pay me 5% a year till the thing matures. So if it's a 10-year loan, I'm going to make 5% for 10 years. So if inflation is going to run higher than 5%, I've got to factor that into my analysis, right? So it's all about fundamentals. And so let's go back to that chart here real quick. Again, this is high yield spreads. So back in 1997, the high yield spread started to rise because the underlying fundamentals of the markets were deteriorating fairly rapidly. And if you look through to a lot of those companies in the dot-com crisis, it was all about just hopes on eyeballs per page, but there were no revenues, there was no income into a lot of these companies, and so the money that was being borrowed was starting to get picked up by the bond market. And in 99 and 2000, they were like, hey, this money we're loaning out on these companies is super risky, and they started to demand more and more and more from those companies in terms of payments, in terms of those bond price, into those bond coupons, right? And so you saw those spreads really starting to blow out. So the bond market warned you, and this is why we were getting out of the market back in 99, is because the credit markets are telling you there's something that's going to break. And the bond market was sniffing it out fast. Right. Okay, so let's flex.
And meanwhile, stocks were like accelerating in their craziness.
Absolutely.
Right? So all you were looking at was the stock market for your signals. You thought the world was awesome, right? Where the bond market was telling you a very different story that obviously proved to be true. Yeah,
absolutely. May 2007. So a year before we actually blew up in the financial crisis, junk spreads were rising. Junk spreads gave you a warning a year in advance of the market downturn. This is why in June of 2008, we were cutting portfolio exposure as well. Same reason is because the credit market spreads were telling you that there was risk to the markets. 2011, you had the same thing here. Then, of course, in 2012, that was where you had the debt ceiling default debate going on here in the U.S. You had Japan getting hit by an earthquake and all kinds of other stuff. But that helped, those credit spreads told you something was going on. Same thing in 2015, 16, ahead of Brexit. There was a lot of concern over Brexit. And then the markets went through basically, 18% and like a 10, 15% and an 18% drawdown almost back to back over the whole Brexit issue. But again, junk bond spreads were telling you starting in 2014 that there was risk coming up in the market. So the point is that every time you go through markets, with the exception of 2020, right, when we shut down the economy just literally overnight, the bond market didn't smoke that one out, and on this one as effectively. But there were other signals that got you out of the market in time for the 2020 showdown. But outside of that, the high yield market has really is your best indicator to tell you when there is risk, and there is no risk in the markets right now. No perceived risk by the bond market right now.
Okay, well, we'll keep revisiting this chart, and obviously the first time you see it really start picking up, obviously let's make that a big focus of discussion for whatever video we do that week. Yeah. I just want to underscore the point I was making one last time here, which is for a market to turn, it needs sentiment to shift, right? And sentiment essentially is belief, right? And that's the difference between credit spreads and the larger market, right? Everything with credit spreads, as Lance said, is just math, right? And so, we've heard that saying, the market can remain irrational longer than you can remain solvent. It can, because the sentiment, the belief can persist for an awfully long time. But what forces that belief to eventually shift? That all starts in the math. That first domino of credit spreads kind of begins the process. And so we're just going to keep our eye there on the credit spreads. And as Lance is saying, hey, we can come up with lots of reasons to think that the market's got a lot of risks in it. But until credit spreads start making some movement, it just seems like positioning aggressively against the market is probably premature.
Right, and we'll be cutting exposure at some point. Again, we have these conversations regularly. We just took some profits. Week before last, we were taking profits in areas of the markets. We haven't done much this past week, but we regularly take profits, rebalance risk. Those rules of gardening that we talk about. that's just a good standard practice. And again, if you'll just implement a discipline within your approach to managing your own portfolio and do some risk management protocols, you don't have to worry about these big macro events, because your portfolio management process will take care of that. And so the problem is, if you're like, oh, I'm not going to invest because I'm worried about the market crashing because of the debt issue, that's impossible to manage against. It's something that's so unpredictable and so far out in the future, may not even be around to see it. But if you have a good, steady, disciplined investment approach where you're buying and selling and trimming and pruning and weeding and doing all the things, fertilizing your garden, you can navigate these downturns in the markets much more effectively and continue to grow your wealth over time.
All right. Very well said. Hey, do me a favor, just pull up that liquidity chart one last time.
Sure.
I should have grabbed one of Michael's, but yours is very similar. I just want to, people, I've heard people say, a good investor, oftentimes, like, their best skill is sitting on their hands.
Right.
And we've heard the stories, they might be apocryphal, they might not be, about, like, the best accounts at Fidelity are for dead people, right? Who just never made changes in their portfolios, and that he did well over time.
Very true.
So let's look at the trough there in that global financial tightness indicator, which is the light blue line here.
Right.
Just look at those times. What if you just waited for that, for a low extreme in that reading, and then you bought, and generally you lightened up at a high on that reading? I mean, you would have bought at the lows in the .com era. You would have bought at the lows in 2009. You would have bought at the lows in 2020. You would have bought at the lows in 2022. No one's ever going to time this stuff exactly right. But if you just kind of gave yourself like hey, if it's, if it's a standard deviation or two above or below the mean, that's going to be my signal to either buy or sell, depending on which direction it's in. You wouldn't have to make that many trades, and you'd probably do really, really well just using liquidity as your indicator. Now, there's no one magic bullet. I'm not advising that people just do this, but if you reduced it to that level, you probably wouldn't do that bad.
Well, and you got to be real, but see that this is the problem with these types of indicators, right? And this is why you can't use them that way. And I'm not arguing, your thesis is correct, okay? Here's the problem. Notice what this says up here at the top: push forward 9 months.
Good point.
Right?
Good point.
So a lot of these things work on, a global liquidity works on a lag. And a lot of these indicators work on lags. And so it's important to be able, and again, I'm not saying this is a bad indicator and you shouldn't pay attention to it, because you should, but trying to use it as a timing device becomes much more problematic. It's the same thing with valuations, right? In the short term, over the course of a year to 2 years, valuations, the only thing valuations tell you in a 1 or 2 year span is what is going on in terms of market sentiment. It's a very high correlation between valuations indicators and consumer sentiment. So, but long term, right, 10 years, they tell you all about forward returns and what your returns are going to be based on those valuations. So using valuations to manage your portfolio is a terrible idea, because all it tells you is what's going on psychologically within the market. People are just willing to pay more. And so if you're going, well, valuations on forward earnings right now are at 21 times earnings, so I'm not going to own stocks. Okay, you're going to miss out probably on a bunch of run in the market, simply because that just tells you that investors are very optimistic about forward earnings right now, and they're willing to bid up stocks. Now, what forward earnings over the next 10 years tell you is that returns are going to be very low. You're going to have lots of problems down the road somewhere, and return structures are going to come down. So, but that's the problem with all of these kind of macro indicators. And I think, they are a part of our analysis. They are part of what we look at. They are part of how we manage, allocation models within our structures to incorporate what these macroeconomic indicators are telling us. But they're just, as I said, they're terrible timing devices.
Got it. Yeah. And yes, and I just want to underscore what I said earlier. I wouldn't suggest anybody use any single indicator to base their trading off of.
Right.
Good explanation of why. But it is, magically, if you had this 9 months forward data in real time, it would be very valuable, you would think.
You know what? You're absolutely right. If we could invest in hindsight, we'd win every time.
All right. Well, look, let's talk about what the market's done over the past week. Lance, maybe you can pull up the S&P. We can look at the latest technicals.
Sure.
Um,
Now this is much better for managing your money short term.
yes, yes. We talked last week, I think, about the analogy of the map versus the headlights on your car, right? This TA is helping us see the immediate road ahead, right? And helping make some tactical decisions potentially based off of that.
Correct. So first of all, before we get into the short-term technicals, let's talk about an important event that occurred last week. And I sent Adam a text trying to see if he can go get Yale Hirsch to come sit on the show for an interview. But that is the function that we triggered a weekly MACD buy signal. So this is important because seasonality and I'm writing an article on this, so I'll have this article out on Tuesday. So if you follow me on Substack, which you should, by the way, you'll get the article as soon as I publish it. Just at Lance Roberts on Substack, you'll find it there. And by the way, I'm still trying to catch up with Adam, so any help would be greatly appreciated. If you're already on Substack with Adam, just click and follow me over there. So I'd appreciate it.
Go help them out, folks.
Yeah. So on Tuesday, though, especially after you put that picture of me up on your Twitter feed to try to get ahead of me on Twitter. So,
So I either need to put up a beat Adam image or a help Lance image.
Exactly. Help Lance on Substack, please. I want to get one of those pictures where I'm like on the street corner begging for food. Will work for follows. So what this chart is showing, this is a weekly chart of the S&P 500 now. And so let's back up for just a second. Markets work on a seasonality. There's a whole variety of reasons why, but markets tend to be strongest between October and May of every year. This is when we call it the seasonally strong period of the year. Stocks tend to rise more often than not during those months.
Yeah, sorry to interject, but I just want to remind folks, the interview I did about a month ago with Jim Carson, he goes into great detail about the seasonality and the different factors that drive different parts of the year. So if you want to do a deep dive in that, go watch that interview with Jim. Sorry, Lance, but it's such an interesting point. I figure folks want to look into it.
Right. No, I'm trying to actually bring up a chart. Hold on a second. Bear with me one moment. What this looks at is just investing $10,000 in the seasonally strong period versus the seasonally weak period. The seasonally weak period is during the summer months. Okay, so that's May, June, July, or basically June, July, August, September. If you just basically got out of the market entirely, and look, I do not recommend doing this because it doesn't work, but in theory, right? If I got out of the market in the summers and I only invested during the winter months, the orange is during the seasonally strong period, the blue is the seasonally weak period. That's your rate of return on $10,000. Huge difference in compounded returns over time.
All right. So this is where the old sell in May and go away comes from, right?
It's absolutely where it comes from. Now, the problem with it is that the timing of the entrance to the seasonally strong period gets a little bit more tricky, because just because you buy on October the 1st doesn't mean it always works out great, because we've had a lot of major crashes and hiccups that occur during the month of October, right? So you had the crash of 87, you had 1929, Black Monday. We've had all these things that for some reason they just always tend to occur in the summer months. Well, Yale Hirsch his father developed this, but Yale Hirsch has continued the trend. He publishes the Stock Trader's Almanac every year. Great read, by the way. Tons of just research data there for you. But they said, okay, can we do better? Can we apply an indicator to time the entrance into the seasonally strong period? And so they settled on a MACD. I've modified it a little bit and added a couple of things to it to try to provide confirming signals as well. That's what this chart is right here. So this is a weekly chart of the S&P. Those black vertical lines are in the month of either October or November, where you start getting these seasonally strong buy signals, and they're all lining up. You're getting multiple confirmations of the same signal. Now, back in 2020, as an example, the signal triggered actually in June rather than October. That was because of all that money that was flooding into the market. It just pulled everything forward in that year. So the seasonal signal triggered very, very early. But again, the markets were doing fine, and they stayed basically on a signal all the way through 2022. Now, we got another signal in October of 2022. So at that low, we were coming down, the market was selling off. And you and I, Adam, were talking about the fact that we were about to go into a seasonally strong period of the year. And, the markets were looking like they were bottoming back then, and we were going to get the signal. So we got this buy signal that turned out to be a very good buy signal. Same thing after that 10% correction that we had last summer. We got, again, seasonally weak period, May, June, July, August. And then in October, we got the buy signal when stock buybacks kicked in. And of course, we've had a very strong rally since then. This summer, we went through the carry trade blow up, and then we had the subsequent little sell-off post that. We've broken out, and we just triggered last week all three of the buy signals. So we now have a confirmed seasonal buy signal going into the end of the year. Just confirming that the seasonally strong period of the year has started. Now, this does not mean that markets can't have a correction between now and the end of the year, or now and sometime in May of next year. Does it mean we're not going to have a 4 to 5% correction or a 5 to 8% correction? Those can certainly occur. We had one in April this year. We had one in July of this year. So these corrections in a bull market can still happen, even though you're on a seasonally strong buy signal for that period of the year. So again, it's not an absolute just throw all your money in. Markets are a little bit stretched and deviated right now. In fact, let's just jump over to our near-term chart. Markets are a bit stretched here. We did break out last week. We talked about this consolidating rising wedge pattern. We've broken out of that. That's bullish. We came back down and retested that breakout. That's bullish. We're on a buy signal on a short-term basis as well. That's bullish. But markets are starting to push up into fairly overbought territory. Relative strength is getting a little bit extended here. Money flows have started to flatten out a bit. So, so buyers are starting to kind of just match sellers instead of buyers kind of dominating sellers, which has been dragging prices higher. So we're seeing a little bit of weakness in flows. We're seeing a little bit of weakness in overall momentum. So again, this is why, I wouldn't be surprised that over the next, couple of weeks, maybe post-election, depending on what happens, and there's a lot of things that can happen between now and the end of November. If we have a contested election that doesn't get sorted out till December, there's a lot of things that can worry the markets. So we're in the zone for a bit of a pullback, but most likely any pullbacks or corrections that we have will be contained to the 50-day moving average and will be a viable opportunity going into the end of the year and potentially in the start of next year.
All right. Okay, so sounds like what you're saying here is, technically speaking, looks pretty much like we've got the bullish green light. If you've got a horizon sort of through the end of the year, any given time in between then, could be a little bit volatile. Things are looking stretched right now. You said we're sort of short-term overbought. So lots of potential reasons why you wouldn't necessarily be surprised to see one of those bull market corrections where it pulls back a little bit, catches its breath, then vaults higher again. So again, don't just put your money in and expect to have, 2.5 months of clear sailing between now and January. But you're saying odds are looking like, if you can stomach a little bit of the pullbacks, things look pretty bullish between now and end of the year.
Well, yeah, and there's three reasons as we move into the end of the year that markets should do better. So first of all, we have corporate share buybacks. Last year we talked about this time of the year. We said, hey, in fact, I wrote an article, a little bit more weakness in October before the seasonally strong period. And one of the reasons back then was corporate share buybacks, and those were $5 billion a day estimated through the end of the year. November and December, because companies make these allocations towards share buybacks, and they say, okay, we're going to do so many share buybacks. Well, they want to get a lot of those done before the end of the tax year. So November and December executes about 21% of all the share buybacks of the year. It's a very, very big tranche of buybacks that get executed in November and December. So last year was $5 billion a day. This year it's $6 billion a day. And so you're going to have that impetus of buying in the markets in November and December, regardless of what else is going on. Second thing you're going to have is that there is a ton of portfolio managers that are grossly behind the markets this year. This market is, they have they deleveraged back in July and August. They didn't buy back in. In particular, they were selling a lot of the big mega seven, magnificent seven mega cap stocks. So they're underweight those shares right now going into the end of the year. So they've got a lot of performance catch up to do before year end. They want to make sure and own those stocks on their books before they do their year end reporting as well. So just from a portfolio management standpoint, there's going to be a lot of chase for the markets to try to play catch up into the year end. And then the third reason is, so you got buybacks, you've got catch up for portfolio managers. And then the third reason is that you just have very bullish sentiment right now. And basically nobody wants to get left out this market. So again, no matter what you own, it's going up. As we wrote about last week, it's the everything market. The market makes you look like a genius right now. So there's nothing to stop those flows of capital at the moment into the markets from just retail and household investors that are just, egging on to get more exposure into the markets. Household allocations right now are at the highest level on record. So again, just the amount of flows in the stocks just kind of keeps coming.
So I was surprised that in your list there, you didn't also have removal of election uncertainty. Would you add it to it?
Well, yeah. If we get right now, the markets are betting that Trump's going to win the election in November, and if he wins by a large enough margin that there's no contest. And interestingly enough, Kamala Harris is the one that has to certify the election. So this will be interesting to occur. But if there's no contest to the election, it's a smooth election, he wins, or who knows, she wins, and there's no contest to the election, then that's going to be very bullish for the markets. I think the one outlier risk to the markets is going to be a function that the race is very close and it becomes very contested, and it goes to Congress in December to get sorted out. That, I think, that 2-month window where you have this debate going on over that could weigh on markets. So again, I think that there's one risk there that we can't discount, and we need to be paying very close attention to, which is going to be the outcome of that election.
Okay, so the election resolution will be a bullish factor unless it's a highly contested election, and then it could actually become a deterrent. Okay.
Right. Yeah.
All right. And I just feel compelled to repeat John Hussman's words, because you said everybody looks like a genius right now. Hussman's famous quote was, "Bubble markets force you to make a choice. Look like an idiot now or look like an idiot later," right? Or look like a genius now or look like a genius later. So just be careful that when the getting is great, like Lance and I were talking about earlier, if you keep thinking you're going to win this, your Super Bowl ring every year, you probably have unrealistic expectations.
Yeah.
All right. So there's a report I saw by B of A. I'll actually try to find the chart and bring it up here. But I'm just curious to your reaction to this, which is they said that they expect the earnings growth of all S&P companies to slow going forward. And you've talked about at times, Lance, about how right now there's really healthy expectations for earnings growth coming into next year.
Yep.
Right. But if you dig into their projections, only 7 stocks make up all of the earnings growth.
That's right.
Meaning that the remaining 493 stocks in the S&P 500 are not growing earnings next year, not expected to grow earnings next year by B of A.
Right.
That is, well, I'm sorry, I don't want to editorialize first. How do you react to that?
No, it's right. I've talked about this a lot. Right now, we're right in the middle of millennial earnings season. Everybody's going to get a trophy because we cut expectations a lot going into earnings season. But amazingly enough, I was just doing some work this morning on earnings. They're expecting basically a $15 jump between third quarter and fourth quarter this year, just a very big jump in earnings. So they're expecting like, oh yeah, we're having a weak quarter this quarter, but man, next quarter is going to be gangbusters. Where, right? I mean, where are you going to, earnings have to come from economic growth. So you're talking about 5% economic growth going into the fourth quarter of this year, which we're going to print around 3% economic growth for Q3. But trying to ramp that up sharply in Q4, I find it a little bit hard to come by. One of the interesting charts right now. Can I steal your screen real quick?
Yeah, go ahead.
I published this morning on Twitter, but this is the Philly Fed survey. There's a very high correlation between the Philly Fed survey and the growth rate for the S&P 500. And not surprisingly, earnings have increased here over the last few months, in particular because the Philly Fed has been increasing on a relative basis. But if we begin to see a deterioration, which we have seen here just recently, then that suggests that the economy is slowing down and earnings growth rate is going to slow down as well. So there's a lot of optimism about earnings going into the rest of this year, in particular in 2025. They're talking about another 18% increase in earnings through 2025. That just seems to be very hard to come by. And that's why, though, forward valuations now are at 21 times earnings. We're running up the market in anticipation of earnings. We keep expecting better earnings growth, but we don't get it. It doesn't grow. It doesn't turn out to grow as much as we think, but we keep bidding it up. And this is why forward valuations are getting extremely elevated here. But again, when you look at the market, the whole market's running right now. But again, to B of A's point, if you actually break down earnings and look at it, the only earnings growth is coming from the top 10 companies. The bottom 490 aren't generating really any earnings growth.
So tell me, Lance, I hear that and my brain wants to rebel. It's just like, wait a minute, kind of the quote unquote the 500 best companies, in the market, all of them but 7 aren't growing their earnings. To me, that just sounds like a very unhealthy economy, right? It's hard to make the argument that is a sign of a healthy economy, and it's certainly, I think, a sign of an over-concentrated market. Meaning, man, if those 7 stocks enter any issues, they're going to have a very disproportionate impact on the indices, right? So I'm not trying to be too alarmist about it, but it kind of fried my neurons when I saw that stat.
Well, no, I mean, you got to remember is that this goes back to valuations, right? So let's just go to the very basis of valuations. Price times earnings. That's all it is, right? Mm-hmm. So the reason that we have overvalued markets is because we're willing to pay more for every dollar's worth of earnings than we were previously. And that's why, now forward earnings are at 20 on a 12-month basis. Forward earnings are at 21, trailing earnings are around 23 times earnings. So in other words, people are willing to pay 23 years worth of earnings for a share of a company today, right?
Right.
They're just very optimistic that earnings will eventually grow into the price of the companies. And that'll be a question for another day. But again, as I said earlier, and this is so very important, is that in the short term, and this is to your point exactly, is like, oh yeah, man, when I look at that, it just fries my neurons. I'm just, it just seems like the market's just being totally, stupid. It is. But that's what valuations tell you in the short term. Right now, investors are very exuberant. They're willing to pay more for earnings on the expectation that earnings are going to play catch up. And right now, the expectations for growth in the economy next year are very strong. So they're expecting a very strong recovery in the economy next year that will boost that earnings growth to catch up with the price they're paying today. Everybody thinks they're buying a discount today for future earnings. We'll see if that happens or not, but that can last a long time before that reality catches up.
It can. And again, nothing I'm saying about this controverts what we talked about earlier, which is there's lots of signs that the current momentum could continue to kind of rage on for another quarter or more. I easily see that happening. But I keep talking about this, trees don't grow to the sky, right? Yep. It's why we don't have, 100 times forward PE ratios, on average, because at some point, the companies just can't grow earnings, that much, as no matter how much investors want to slap a higher price on the stock. And when I see that much, I mean, honestly, almost all of the S&P not growing earnings, I'm just like, then how the hell can you support these crazy forward PEs that we have for much longer. And again, I don't know how long, much longer is, but I feel like it's like, it's like the grain of sand, the grains of sand they put into a pile. As much as scientists have studied it, they can't calculate which grain of sand is going to collapse the pile, right? When the pile reaches a certain height. But as the slope begins to increase, they can increase the probability, they can calculate the probability of a collapse, right? And to me, that data is just kind of like, wow, that sand pile seems real steep right now if just about every company is not growing earnings over the next year.
Well, and again, it's just very, very important to this is that, again, you're absolutely right, right? And again, there will be a correction at some point in the future. Now, we're not talking a crash. We're not talking .com style 50% correction, right? But there will be a correction at some point when earnings reality doesn't catch up with fantasy, right? And so you're going to get a 10, 15, 20% correction, just like we had in 2022. That's going to happen again at some point. The problem with it is it could be in 2025, it could be in 2026, it could be in 2027. Right. And so that's why, we have to be aware of these things. And that's why we write so many articles talking about earnings growth. And in fact, this whole weekend's newsletter, this entire weekend's newsletter, which will be on the Substack, follow me there, is dedicated to earnings, Q3 earnings. We're going through a whole bunch of charts looking at Q3 earnings, expectations for growth, those type of things. And right now, there's certainly some concerns. Optimism by analysts is extremely high. Analysts always historically overestimate earnings by about 30%. So whatever number they start with, they come out and say, we think that the S&P is going to earn $10. By the time we get to earnings, they're down to $7, right? So they're always 30% too high. So again, we have to take this with a grain of salt and just understand that the value that we pay for today, and this is why you should never use analyst estimates to buy stocks because you're always going to overpay for them. But that drives market exuberance in the near term because analysts are telling the people they're selling product to, hey, don't worry about it. It's all fine.
Right.
This is going to be great. Buy my product. And that keeps this whole game going. Eventually that music will stop. But again, it could be a year and a half from now.
Right. And one of the reasons why I keep bringing this up is not to deliver any sort of, it's all going to crash tomorrow, go fully to cash. It's to help you explain to people how you are still on the dance floor, if you will, but keeping an eye on the door and, actively managing long positions while having provisions in case this stuff starts to matter.
Yeah, absolutely.
Yeah.
Absolutely.
Okay. So in a little bit of a, topical of like, the market is being powered by just a very few stocks, largely driven by AI, right? And what happens to what happens if something happens to one of them? We've recovered from this, so I don't want to paint it as something that's dragging the market down in real time. But can you talk for a second about what happened with ASML this week?
Yeah. It was interesting because initially it came out, I was like, oh my gosh, what does that mean, for the whole AI sector? And what turned out to be is that this is what, they came out, made their announcement and basically cut their guidance. That was the big thing, that the number of things that they were going to sell was going to be down by about 50%. That all wound up having to do a lot with the bans that we have put on Chinese products. And so that's really impacting them. Go ahead.
I just want to make sure folks know, yes, that is true. Part of this was the announcement was mistakenly released like a day early.
Correct.
Right? So there was no chance for the company to kind of massage, set expectations, put a spin on it. It just freaked everybody out because it came out of nowhere. Yeah.
Right. Exactly. And that's the other thing. But yeah, I mean, this is, but I think it's very symptomatic though, is that if I release if my company is priced properly, right? And maybe only a small, and look, companies should carry a premium to their net asset value, right? So, you shouldn't be trading stocks at a 1 PE, right? They should trade at a multiple.
Right, they should price in expected growth, hopefully reasonably expected, but yes.
Right. And so, if I'm priced at 10 times earnings, as an example, and I come out with really bad news, like, oh, I had a really bad quarter, maybe my stock's down a few pennies, right? Because I'm still priced, very quickly the market will go, yeah, bad quarter, they'll make that up, it'll be fine, go forward. But when you're priced at 20, 30, 40, 50, 60, 70 times earnings and bad news gets released expectedly or unexpectedly, you can see these very big declines in price. And that's that readjustment to reality. When fantasy hits reality, right? That's the problem. You get this knee-jerk reaction. And it's also a function of the fact that we now trade so fast. There's no time. And I think this is we've talked about this before. It's a huge disadvantage for retail investors than the way it used to be, because there's no time, as you said, there's no time for data to get absorbed by the market before it gets into retail hands. And so now we just see these computers immediately, the news comes out and the computers just go sell. Right. And by the time you get home, it's too late to do anything about it. And now there's all this trading that happens overnight that you can't participate in. So you really get kind of monkeyed hammered at the market open. There's a lot of disadvantages to the way we've structured markets today. I long for the days that markets traded more normally. That sure made life a lot easier. But we have to just deal with the environment we have. But what's important is that the CEO of NVIDIA came out right after that and said, we have so much demand for our new Blackwell chips. It's literally insane. And then they also announced Elon Musk fitted 100,000 of the Blackwell GPUs in 19 days in a liquid cool facility, which it takes a company a whole year to do that. And he did it in 19 days. So that's all compounding into NVIDIA, and that stock had hit record highs earlier this week. So.
Okay. Well, look, one thing I want to just sort of the parting point on this, potentially revisit in the future if events merit it. But Fred Hickey, who I've had on this channel before in the past, he publishes the High Tech Strategist newsletter, highly respected newsletter about high tech. He's been publishing it since the 80s, meaning he really understands this sector. He has been ringing a warning bell about the potential underperformance of AI to current market expectations. And I will tell you, in the conference that again is going on in parallel with us right here, Lance, he delivers the most strident message on that I've heard him yet deliver. So will be interesting to see what happens. But obviously right now, party rages on. Who knows? Maybe it'll continue raging on forever. We'll see.
No, nothing's going to last forever.
Nothing's going to last forever.
And look, and eventually he'll be proven right. And it's just like Stanley Druckenmiller just recently came out and said, I sold my NVIDIA shares way too early. The problem is that the AI run right now is just really getting started, and all the development that will occur off of AI is just very young in terms of this cycle. But so you're kind of standing in front of a locomotive right now, trying to stop it. There's a ton of momentum behind this sector, but again, when the market or when the sector in general starts to show signs of weakness and we start breaking trends, then we'll sell our positions. But until then, we're just going to ride the train, right? We have no idea where that train ride ends, but it'll end eventually, but we'll just make money with it while we can.
Yep. Okay, great. All right. Well, look, I'm going to start trying to wrap up a little early here just because I've got to finish the preparations for the conference, which again, the day we're recording this is the day before the conference. The day everyone's watching it, the conference is either happening in real time or it's already in the rearview mirror. Let me just ask you this. Oh, and I do want to give you a chance to talk about your broken window piece. So I will make good on that. Your colleague, Michael Leibowitz, who again is also speaking at the conference that's going on right now, he wrote a piece this week about basically the VIX, and we have an elevated VIX and we have a rising market. They don't always go hand in hand. Doesn't mean they can't, and he talks a bit about that. I guess my question to you is just, should we care about the VIX being elevated, and I probably over exaggerated by saying elevated. It's at 20-ish something right now, which just feels elevated because it's been so suppressed for so long. VIX can certainly go a lot higher than it is right now, but does a rising VIX in this rising market tell us anything that you think folks should be aware of?
No, I think it's something that's definitely worth paying attention to, and we spent a lot of time in our shop looking at the VIX. We had bought VIX calls heading in about a month and a half ago, and we have a model we call our platinum model, which uses options and things in it. And in that portfolio, we bought VIX calls to hedge election risk, and those all expired in the money over the past week. So it worked great as a hedge for the portfolio, even though the rest of the portfolio, it was supposed to hedge the portfolio in case the market went down and corrected in October, but everything just went up. So we just
ended up being a tailwind. Yeah. Hey, I should have said for folks who might not know, VIX is a market indicator for market volatility. So that's really what we're talking about. We talk about VIX. Yeah.
Yeah. And again, this is something that that's very important. And so, it's important to look back is that when you take a look at the VIX can rise for a period of time and not signal anything. That can happen. And again, remember, the VIX is just simply people buying puts, people buying calls, just people basically betting against each other about where they think the market's heading to next. So it's possible for the markets to rise and the VIX go up as well. And that's what's been happening as of late. Where people are kind of making a little bit of mistake with the VIX is they're like, oh, well, this means the market's about to crash because the VIX is rising. That's not necessarily the case, because when the VIX, when something happens in the market, the VIX goes straight up and generally from very low levels. So in other words, when the VIX is very low and there's a tremendous amount of complacency, that's when the risk of a market event really picks up, because nobody is hedging for a correction. Then something like the VIX or the yen carry trade blows up and the VIX is at 100 the next morning.
Right.
And of course, it's too late at that point. You can't do anything about it. So, it's the VIX doesn't tell you as much when it's just trending a little bit higher. But there are periods in history, if you go back, and we did some analysis on this and we look back at long-term charts, there were some previous periods where you would get this kind of slow trending rise in the VIX, and then it would go higher up. So we still pay attention to it, and we're paying very close attention to the VIX right now. And this is why, because of what's going on, we've taken some profits, we've rebalanced risk in the portfolio a bit, because if something, and again, it could be the election. Again, the election goes completely haywire on November the 5th, and the next morning the markets are in shambles because of whatever occurs. I mean, that can certainly happen in the market. The VIX would be at 60, 80, 100, right? So again, the way you approach this is don't worry so much about where the VIX is. Pay attention to what it's doing, and what it suggests right now is, hey, be a little bit more risk averse. That doesn't mean be all in cash. It just means, hey, if you've got stocks with really big gains in them, take a little bit of profit, reduce those back to their target weights, hold a little bit of extra cash. Just because you sell something doesn't mean you have to buy something in tandem. We're just holding a little bit of extra cash. And if we do get some type of market surprise, we've got cash to go buy stuff with. Kind of like we did back after the yen carry trade, we were buying back in late August. So we want to use those opportunities to our advantage when they occur, because again, whatever event occurs, then right behind that, you're going to have stock buybacks and yield run chase for the end of the year, et cetera. So there'll be a lot of bias to the upside, after that, whatever that event is.
Great. Okay. Well, look, I don't want to shortchange you. So if the topic requires more time, we can move it to next week. But in the last couple of minutes, do you want to go through your Bastiat and the broken window piece?
Yeah. No, the whole purpose of this. So in the 1850s, Frederick Bastiat he was an economist, and he proposed this theory about broken window pane. So in theory, a kid breaks out a window and so the baker has to go to the glazier, and he's got to buy a new window. And so the glazier needed some new shoes. So he takes the money he got from fixing the window to go buy a pair of new shoes. And the guy that he bought, the cobbler that he bought the shoes from, turns around and buys a loaf of bread from the baker. And so everybody makes money. And so economists have jumped onto this, and it's always interesting. And right after we have our hurricane, immediately this comes out. I was like, oh, this is actually going to be great for economic growth. It is true. We will have a bump in economic growth. So if you're expecting a recession to come right around the corner, it's not going to happen because of Hurricane Helene and Hurricane Milton. That's going to basically give you a bit of boost to economic growth in the short term, because all, the companies that were out there have to go out and replace things. People that lost their homes and everything that they owned in this tragic event is going to have to be replaced. But therein lies the fallacy to economists. And even Frederick Bastiat noted this. He says, this is a temporary impact. They assume that this destruction is going to create organic economic prosperity for the economy. And that is not the case. This is a chart of economic growth and versus our economic composite of wages, inflation, and rates. And again, as we talked about before, there's a very high correlation between wages, inflation, and rates and economic growth. They're all tied at the hip. And then all this chart does is kind of prove that. But what you see is the economic composite is in red. So that's wages, inflation, and rates. And the black is just gross domestic product. And of course, what you'll see is that after hurricanes, we get a little bump in activity because we've got to go out and do a bunch of stuff. So people make a little bit more money because construction workers are having to work overtime to play catch up. So they get paid more. They get paid more in wages. Retailers make more money because everybody's having to, go stock up on whatever stuff they lost during, replace food, replace clothes, TVs, all that stuff has to get all replaced. But we're not creating new economic prosperity. All we're doing is replacing what was broken previously. And again, we'll see a bump in retail sales from this because everybody's got to go out and buy these things. So we'll get a bump in retail sales. But we're not doing new sales. We're not putting capital to work in a new manner. And this is the problem with this theory. And once we start looking forward, this is where this really starts to have an impact. All we're doing is pulling forward future consumption. So as a business, if I was an industrial manufacturer of something and I lost my entire building, I've got to go spend CapEx dollars to rebuild my building and buy new tools and equipment. So yeah, there'll be a short-term bump. But that money I was planning on using to invest in a new plant that would have expanded my production a year from now. But now I can't do that because I'll spend all.
It doesn't get invested. Exactly. Yeah. And I'm so glad you're talking about this because, so many, even economists fall into this trap, but certainly Wall Street looks at this as growth, right? Where it's not, you're just filling a hole.
Yep. With money. And the same thing goes for retail investors, right? So I had money that I was going to invest in the markets, or I had money that I was going to buy a new television with that I didn't have before. Or I was going to spend money, to take my wife on a trip, but now I've got to use all my capital just to replace my everything I lost. So now all the stuff I was going to do with my money, all the savings that I was going to have for retirement, all the investing that I was planning on doing, that's gone. So that wealth building for retail investors goes away as well. And that provides a long-term impact to those individuals they won't recover from because you can't make up for the lost time and the capital that was spent just getting back to where you were, right?
Right. Yeah, and there's no doubt that it's not in some ways a wealth transfer to the people who were involved in the activity to fill the hole, right? The ditch diggers that you're paying to get out there with their shovels and dig the hole, they're going to be better off, right? But the entire society is actually worse off because you end the process with only what you had before, but you had to expend additional energy in the process just to get back to where you were.
That absolutely right. And this is kind of a key factor is that, if you take a look back throughout history, whenever we have hurricanes, you get a spike to earnings, right? Corporate earnings pick up because everybody's having to spend money to do stuff. But notice what happens immediately after that bump. Earnings decline because now everything that people were going to spend to create earnings growth. And where does earnings growth, earnings growth comes from economic activity. It just doesn't magically appear, right? People got to do something. Well, there's no money to do anything with. So you get this bump to earnings. You see in Hurricane Harvey, Irma, Maria, we had the trifecta of hurricanes back in 2017.
Mhm.
And then in 2018, 2019, 2020, earnings declined because we pulled forward all of that activity. Same thing for Ida, right? And so now we're going to see a bump to economic growth because of the hurricanes. And again, it's a terrible tragedy. There's nothing good about this, by the way. And I keep saying that because it's my concluding point. And secondly, so we'll see a bump in earnings, and then that will fade because we now have left a void in the future for what's going to ultimately have to be worked out. So I concluded I posted this out on Twitter this morning and on Substack. So follow me there. I wanted to show you this one tweet because
Sorry, forget about the broken window fallacy. We've got Lance the broken record now.
Exactly. Hey, it's no different than you saying, hit that button and subscribe. Anyway, I'm really pushing to catch up with Adam here. No, but seriously, this is how I concluded on Twitter. This was a conclusion from the article. I said, while economists have praised hurricanes for providing an economic boost, think about it this way. If destruction is beneficial to economic prosperity, why not have an annual event where the government carpet bombs a major city? So when you view it in that manner, the logic of the argument of creative destruction, it becomes self-evident, right? I mean, It's just that's just stupid. We wouldn't go around bombing us. Although there's a few cities we could probably think of to start with, but it doesn't create long-term. Destruction is not a remedy for prosperity, right?
That's a great way to put it. Yep.
So,
all right. So everybody sort of steel yourselves for the announcements coming up in the next quarter about all the spending that's being done to rebuild and how great that is for driving GDP, because that's all going to go to GDP.
Right? Yeah. Oh, yeah. You're going to see it. You'll see a nice bump to GDP. I mean, we could be running at 4% GDP by first quarter of next year. So, and again, everybody's like, this doesn't make sense. It's all government fiction. Doesn't matter. The markets are going to respond accordingly, and you're going to get a bump from this.
Right. But it will be phantom GDP. Yeah. And so you may get a sugar bump from the market, but then to your charts, you will then have to pay the price later on. So just be aware of that dynamic.
Absolutely.
All right. Well, look, well said, Lance. All right. So we got to wrap it up here for all the reasons of getting the conference launched. Just a couple of quick closing notes. One, we had a rant from last week that we said we'd push off to this week. We're going to push it off again for another week. Also, I did get a couple of requests from people that are kind of nervous about the TLT trade because yields have moved up as high as they have. We just didn't have time to do it justice this time around, folks. But I will ask Lance about it next week. Can
I just say one thing about it real quick? Nothing has changed with the TLT trade. It's fine. The only reason that yields went up because they had gone down so much. It was a buy the rumor, sell the news of the Fed event. And then you had a spike in oil prices, which is now over. Yields track oil prices, and there's a very high correlation to that. So now that oil prices are down back below 70, yields are going to follow suit. Go ahead.
And I will say that your partner, Mike Leibowitz, gives a very, if you're in the TLT trade, he, cool as a cucumber, it gives his logic at our conference about why he's not sweating at all, and reaffirms why he thinks the trade is still going to continue to perform well. So
I'm sure that corresponds with Lacey Hunt as well. So
yes. And I will say at a very high level, Lacey Hunt is a lot less sanguine about 2025 than a guy like Michael Howell. I'll just put it that way. Okay, and then I think we talked about this. But I just want to let folks know I'm delivering on it. I did end up recording a very detailed conversation with the head of the Center for Immigration Studies on the topic of illegal immigration and border security, really just trying to get to the facts. We try to do it in as unbiased a manner. The Center for Immigration Studies is a nonpartisan organization. I think Dr. Stephen Camarata, who was their head of research, who's the guy I interviewed, I think he did a really good job of answering a lot of common questions that people have, just trying to understand what's going on in as very data-driven a way as possible, that's very respectful of all parties, and is very level-headed. And I'll preface this by saying, if you have an extreme opinion on one end of the spectrum, you're probably going to find stuff in there to disappoint you. Like many things, it's a nuanced story. But from my perspective, going into it as just a curious citizen, very educational, and I think it's very important that people get these facts because they do paint a pretty clear picture. And if you want to understand what that picture is, watch the video. It's coming out the day after this video airs, so it'll come out Sunday, October 20th. Yeah, just want to let folks know that I did decide to grab that third rail topic, but I think it's a very important one because it does have economic implications, and it is, by many polls, the number 2 voter issue that people say they're going to cast their vote for. And I think the vast majority of voters don't feel informed enough about the topic, which again is one of the main reasons why I did it. All right. Lastly, if you think one of the most important things for voters to keep in their minds when they go into the voter booths for this presidential election is to make sure that they watch Lance Roberts on this channel week after week, please let Lance know that by hitting the like button and then clicking on the red subscribe button below, as well as that little bell icon right next to it. If you want some assistance in your investing and helping navigate the road that Lance sees ahead, highly recommend that you do that under the guidance of a good professional financial advisor. And again, if you'd like some help and don't have a good advisor already who's doing that for you, consider scheduling a free consultation with one of the advisors that Thoughtful Money endorses, perhaps even Lance and his team there at RIA Advisors. To do that, just go to thoughtfulmoney.com, fill out the short form there, only takes you a couple seconds. And these folks will be, these firms will be right in touch with you very shortly thereafter to schedule your consultation. I won't go into my normal song and dance about the conference, but if you want to buy the replay again, just go to thoughtfulmoney.com/conference. You can buy it there. Lance, as usual, I'm going to give you the last word.
No, thanks a lot. I appreciate the time today. And don't forget to follow me on Substack.
That's going to become a weekly thing now. I know you're going to lead with that going forward.
No. I'm just playing. So anyway, I certainly appreciate the time here. And again, just, I get a lot of emails like, you're so bullish and all. I'm really not. It's just that right now the markets are bullish and we have to remember that.
Hold up your logo. Show them the eagle.
Yeah.
There you go. Use the eagle. All right. Well, thanks so much, buddy. Again, really appreciate it. Great week. Look forward to seeing you next week. Everybody else, thanks so much for watching.